Today, I'd like to take a look at the U.S. financial sector. It's just started its strong seasonal period, which lasts from mid-December, December 15th, until April the 13th. The financial sector tends to perform well at this time of year. Not every year is a little bit different. Some years will underperform, other years will outperform in this period. But on average, it tends to do well based upon the U.S. financials reporting their earnings to the U.S. banks in mid-January, and also to do with money flows around this time of the year, which tend to give this overall sector a boost. If we take a look at this top graph here, we can see that this is the average year from 1990 to 2019. Every year is different, but this is the average year. This bottom graph here represents the performance of the financial sector relative to the S&P 500 from 1990 to 2019. When the line's moving up, it means the sector is outperforming the S&P 500 and vice versa. I want to point out that here that we can see the bottom being put in for the financial sector relative to the S&P 500 in November. And that's exactly what happened this year, actually, is we saw the U.S. financial sector have that pop that occurred and outperformed the S&P 500. And typically, a sector starts the seasonal period in mid-December. Although it looks like it's higher on average, you have to take a look at also frequencies of success to incorporating in the start of the seasonal period. In general, mid-December tends to be a better period to enter into the sector itself. You can see here that in January, we can see a little bit of a downturn for the sector in the first half of the month on average. That can take place despite being in a strong seasonal period. And that sometimes as the market settles down at the beginning of the year, coming into earnings, the sector can temporarily, on a short-term basis, underperform. The real sweet spot to the seasonal trade really is from mid-January until mid-April. So we're just coming up to that time period for the U.S. financial sector. As we've seen, the U.S. financial sector actually performed quite well recently and could be setting up quite nicely for its real sweet spot to the trade. If we take a look at this graph here, we can see here the top panel is represented by the ETF XLF that trades in the U.S. This middle panel here, the second panel down, is the financial sector XLF relative to the S&P 500. When the line's rising, it means the financial sector is outperforming the S&P 500 and vice versa. And this bottom panel, I think it's important here. It's a little bit different. It's important to always track this bottom panel when you're looking at the financial sector. And this is the yield on the 10-year Treasury note. And the reason is when the yield is rising, the financial sector tends to outperform the S&P 500. When it's falling, it tends to underperform. And the reason why this occurs is the banks have a higher net interest margins as interest rates rise. That's the spread between the deposits that come into the banks and what they lend out tends to increase as interest rates rise. And you can see these two lines here, the performance of the sector relative to the S&P 500 and the 10-year yield are generally the same. There's a fairly strong correlation, and obviously there's going to be some exceptions along the way. But in general, as the 10-year Treasury note yield decreases, you find that the sector underperforms the S&P 500. When the interest rates go up, the financial sector tends to outperform. When the interest rates go down, once again, it goes down. And you can see here that up. Now, in 2018, we saw this exception take place where interest rates actually went up and the sector underperformed. Now, and this is a little bit of an aberration. What we really saw was investors start to become concerned as the Fed was raising rates and talking about really tightening up with the whole neutral thing that it was going on at the time, setting neutral, and nobody knew where it was, and everybody was scared Powell was going to raise the rates to the moon. Everybody was scared about the overall economic impact. And this is a tipping point when interest rates go up. Artificially, when they're pushed higher, investors start to become concerned that it's going to affect the overall economy and the financial sector. Well, as we know, the story went, basically Powell pivoted in December 2018 and everything got back to normal again. Interest rates went down, the sector underperformed. And when interest rates did go up towards the end of 2019, once again you found that the sector outperformed the S&P 500. In 2020, we saw interest rates go down a lot because the Fed forced them down to try and stimulate the economy, and the sector underperformed the S&P 500 quite substantially. Right now, we're still not back to the 2020 start of the year for the sector using XLF. We can see here that what's happened here is interest rates have started to increase in the States while they did in mid-August. Now, most investors would say, oh, interest rates can't go up too high because the Fed's going to put a cap on them and because of what they've stated in the past. And that's absolutely I can't say it's absolutely true, but it probably is going to be true that the Fed will take action if interest rates start to get too high. But nevertheless, we saw interest rates start to increase here. And initially what you saw was the financial sector perform at market, the same as the S&P 500. And when the market went to risk on and interest rates had a quick tick up in November here, we saw this big, huge jump for the financial sector relative to the S&P 500. And then we've seen slowly, as interest rates have gone up, we've seen the consolidation of that taking place as we come into what I call, or very shortly, the sweet spot for the seasonal period for the financial sector. So right now, the sector's set up quite well to go into its the sweet spot of a seasonal trade. Now, the one risk is if interest rates start to go down and start on a steady trend, and investors expect that to continue to happen, the financial sector could underperform. But given that we're still in the trend for the interest rates increasing, and we're in this coming up to the sweet spot for the financial sector, and given that recently the Federal Reserve has announced that the U.S. banks can now buy back their shares, announced that on December around December the 20th, J.P. Morgan came out and stated very quickly that they were going to buy back, had planned to buy back $30 billion worth of shares. So as we come into the earnings, which take place, banks start off the unofficial earnings season in mid-January. In this case, they start off the earnings season on Friday, January the 15th. Investors could become a little bit excited if banks do have positive earnings, particularly now that they can buy back their shares over time as well. So a little bit of fundamental support along with some technical positive trends. At the same time, we're in a strong seasonal period for the financial sector. Thank you very much for joining me today.